That is all that is left before HMRC's July deadline closes. And if you are one of the millions of UK taxpayers this affects and you have not acted yet, the cost of doing nothing just became very specific. It is not a vague warning. It is not a general reminder. I am talking about a real date, the 31st of July 2026, with real interest charges that begin running from the 1st of August if the money is not in HMRC's account. And what makes this particular deadline dangerous is not the people who know about it and are choosing to ignore it. It is the people who have absolutely no idea it applies to them. People who filed their tax return back in January, paid what they owed, and assumed that was the end of it until next year. It is not the end of it. And for some of them, a bill is accumulating right now that they have no idea is coming. Today, I want to cut through every piece of confusion around this deadline and explain exactly who it affects, what the numbers look like, and, because this is the part most people miss, what you can actually do about it if paying in full right now is not possible. Before we get into it, if you are not subscribed to this channel, please do that now. HMRC's rules, deadlines, and thresholds change constantly, and they do not send a personal explanation when they do. Hit subscribe, turn on the bell, let us get into this. The deadline on the 31st of July is called the second payment on account, and to understand what it is, you need to understand how HMRC collects tax from people who are not on a standard pay wage, people who are self-employed, landlords, directors, or anyone else who files an annual self-assessment tax return. HMRC does not wait until the end of the tax year to collect what you owe. It makes you pay in advance, in 2 installments across the year, based on what you owed the year before. The first installment was due on the 31st of January 2026. The second is due on the 31st of July 2026. Each payment is half of
your previous year's self-assessment tax bill. The reason so many people are caught out by the July payment specifically is that it arrives 6 months after January with no accompanying tax return, no fresh calculation, and no formal reminder letter. It simply arrives on the calendar, and HMRC expects it to be paid. Whether you remember or not is entirely your responsibility. Here is what the numbers look like. If your self-assessment tax bill for 2024 to 2025 was £6,000, HMRC calculated 2 payments on account of £3,000 each, one in January and one now. If your bill was £10,000, you are looking at a July payment of £5,000. If you are a sole trader, a landlord with rental income, or someone who earns significant income outside of PAYE, these are not unusual figures. And if that money is not transferred by midnight on the 31st of July, HMRC's late payment interest rate of 7.75% starts running from the 1st of August. That is the Bank of England base rate plus 4%, confirmed by HMRC and active since January 2026. On a £3,000 bill, 60 days late costs approximately £38 in interest. On a £10,000 bill, 60 days late costs approximately £127. It does not sound dramatic until you add up every month it accumulates and then look at what comes next in January. Now, here is the piece that applies to a completely different group of people, and it is catching more UK taxpayers than almost any other HMRC issue right now. You do not need to be self-employed. You do not need to be a landlord. You may be a retired pensioner who has never filed a tax return in their life, and HMRC may still be heading to your door this summer with a bill you were not expecting. It is called a simple assessment. It is an official HMRC letter marked PA302, and it arrives through the post. 1.32 million of them were issued for the 2023 to 2024 tax year alone, a figure that has been rising sharply every year because of a combination of factors that are
pulling more people into taxable income without them realizing it. Here is how it happens. The personal allowance, the amount of income you can receive before paying any income tax, has been frozen at £12,570 since 2021 and is now confirmed frozen until April 2031. The full new state pension for 2026 to 2027 is £12,547 £60 a year. That is a gap of just £22.40 between the full state pension and the point at which income tax begins. Any additional income at all, a small private pension, savings interest earned on money sitting in a bank account, a part-time income, closes that gap immediately, and the moment your total income crosses £12,570, HMRC calculates the tax on the excess and sends you the bill directly. Banks now report savings interest to HMRC automatically. Your pension provider reports your private pension income to HMRC automatically. The DWP reports your state pension income to HMRC automatically. HMRC sits on all of that information and does the maths without asking you. Then the letter arrives. According to figures published by A.J. Bell in autumn 2025, around 2.64 million UK taxpayers were expected to owe tax on savings interest alone in 2025 to 2026, more than 4 times the number from just 4 years earlier, driven almost entirely by savings rates that have stayed elevated while the personal savings allowance has remained frozen at £1,000 for basic rate taxpayers since 2016. For a basic rate taxpayer with a savings account earning 4.5% interest, a balance of just over £22,000 is enough to push savings interest above the £1,000 tax-free allowance. For a higher rate taxpayer, that threshold drops to around £11,000. If your savings are above those levels and you have been watching the interest accumulate, HMRC already knows. The question is not whether the tax is owed, the question is whether you know a letter is on its way and what to do when it lands. If a simple assessment letter from HMRC has already
arrived, or when it arrives, do not set it aside. The payment deadline for assessments issued before the 31st of October 2026 is the 31st of January 2027. For assessments issued after the 31st of October 2026, the deadline is 3 months from the date on the letter. Miss either, and interest begins accumulating immediately. But here's the piece most people do not act on. If the figures in a simple assessment letter look wrong, and they sometimes are wrong, you have 60 days from the date of the letter to challenge the calculation by contacting HMRC on 0300-200-3310. HMRC's automated system calculates these letters using data from banks and pension providers, but it does not always account for every allowance, every deductible expense, or every nuance in a joint account where interest has been split differently from the assumed 50-50. If anything in the letter does not match your own records, the 60-day window is the time to raise it. After that window, the figure becomes the legally accepted amount, and silence is treated as agreement. Now I want to talk about the part of this situation that matters most for people who know they owe money and cannot pay it all at once. This is where people make the most costly mistake, not through dishonesty, but through avoidance. The bill arrives, it is more than they can cover right now, and rather than contact HMRC, they simply do not respond. That is the worst possible approach, because HMRC has a formal arrangement specifically designed for this situation, and it is available to anyone who asks for it before the deadline passes. It is called a time-to-pay arrangement. If you contact HMRC before the 31st of July and explain that your payment on account is due, but you are unable to pay the full amount immediately, HMRC will work with you to set up a payment plan, weekly or monthly installments spread over an agreed period. Any payments already made under a plan count toward your final tax bill. You will still be charged interest on the outstanding amount, but you will not face additional enforcement penalties while the arrangement is in place. A plan agreed before the deadline is treated very differently from a bill that HMRC has to chase because nobody responded. The time to pay number is 0300-200-3822. If you are struggling with a self-assessment bill right now, that call is the most important thing you can do today. Let me pause here for a moment. If anything I have just covered has surprised you, drop a comment below and tell me which part. I want to know what gaps this channel is actually filling, because it helps me understand what to cover next. There is one more thing I want to cover before the recap, and it is the part that could actually put money back in your pocket rather than take it out. If your income has genuinely fallen since last year, if you are self-employed and your earnings have dropped, or if you return to employment under PAYE, or if your rental income has reduced, your July payment on account may be calculated on a tax bill that no longer reflects your real circumstances. You are allowed to reduce your payments on account if you have a reasonable basis for believing your current year's liability will be lower than last year's. This is done through your HMRC online account by submitting a claim to reduce, or by completing the SA 303 form. The practical point: if you reduce too aggressively and your actual bill turns out to be higher, HMRC charges interest on the shortfall at the same 7.75% rate, backdated to when the payment was originally due. So the reduction needs to be defensible, based on your actual current year position, not an optimistic estimate. But if your income has genuinely fallen, and you are paying based on a bill from a higher earning year, you may be significantly overpaying right now. A reduction is legal, legitimate, and something HMRC's own guidance acknowledges as a normal part of the system. So here is where everything stands.
With 11 days left, the second payment on account for the 2025 to 2026 tax year is due on the 31st of July 2026. It applies if you filed a self-assessment return last year, owed more than £1,000 in tax, and more than 20% of your total tax was not collected through PAYE or another source. The amount is half of last year's total self-assessment bill. Late payment interest of 7.75% starts running from the 1st of August. If you receive a simple assessment letter, a PA 302 from HMRC arriving through the post, it is a real tax demand. Check the figures against your own records. You have 60 days to challenge any errors by calling 0300-200-3310. If the figures are correct, pay by the deadline shown on the letter. If you cannot pay your July bill in full, do not ignore it. Call HMRC's Time to Pay line on 0300-200-3822 before the 31st of July. A payment plan arranged before the deadline prevents enforcement and limits the financial damage. And if your income this year is genuinely lower than last year, check whether you are entitled to reduce your payment on account through your HMRC online account. Overpaying now to get a refund in January is poor cash flow management when HMRC's own rules allow you to adjust the payment today. HMRC does not send a personal reminder before the 31st of July. The deadline is in the calendar and it is yours to manage. The interest that starts on the 1st of August is automatic. The enforcement that follows an ignored bill is also automatic. None of what happens after the deadline requires a human decision from HMRC's end. The system runs by itself. You now know exactly where the deadline sits, what it applies to, who it catches, and what to do whether you can pay, cannot pay, or think the figure you have been given is wrong. If this video helped you, share it with someone who is self-employed, a landlord, or a pensioner who has been receiving higher savings interest this year. The 31st of July does not announce itself to the
people it is about to catch. One share could make the difference between someone dealing with this in time and someone discovering in August that the interest has already started. Subscribe if you are not here already. There are more deadlines coming in the months ahead, and they will land the same way this one did, quietly and without a personal letter warning you in advance.